Yield curve inversion. So for those that aren't familiar, that could mean that we're potentially heading into a recession in the next 12 to
It's
18
only a
months.
95% predictor, though.
Only
Don't overstate it.
95%. Okay.
Welcome to the Bar Down Investing Show. Here are your hosts, Kyle Wilson and Jay Scott.
Hey there, and welcome to the Bar Down Investing Show. I am your host, Kyle, more affectionately known in the industry as Ashley Wilson's husband. I am here with my co-host, Mr. Jay Scott. How's it going, Jay?
Everything is going well. I think we have. Let me start this show off because I think I have an important announcement. It is your birthday today. Happy birthday!
It's weird to say that because we're taping it before the birthday, but thank you in advance for my
Yeah.
birthday. Actually, we're taping this on Sunday, which is football Sunday, and I got you can see, got my Eagles hat on. Go Eagles, or go Birds. I'm assuming we're going to be talking by the time this releases. They're going to be 11-1. So we finally got this done. We've been trying. This is the third or fourth attempt at recording this episode. We've had 4 or 5 other recordings that we've already done. So we are ready to go. Hopefully this one gets through, and we can get some great content out to people.
Yeah. So for everybody listening, why are we doing this?
Yeah, so it's a funny story. We decided we had to do a podcast. Ashley and Jay started doing it, and Ashley's my wife and the CEO of our company, Bar Down Investments, and she hates it. So she had me take over, and when we were discussing what we wanted to do, we wanted to get something out there that was a little bit more fun, a little bit less like the standard format of just interview somebody and every week someone new interview, new topic, something like that. And we were discussing this while we were sitting at a conference and having a couple drinks with a couple friends, and we were like, why don't we just do this? We have some drinks and talk real estate. Unfortunately, drinking and talking in real estate, you can't just do that every week,
Well, you can, but it gets expensive, and my wife gets pissed at me for flying around the country to hang out with friends and drink while she stays home with the kids. So, so I guess we had to add a real podcast piece to it all. So, what we ultimately ended up deciding is we're going to do 2 podcasts a week. And this is going to be your typical Tuesday format where Kyle and I are going to come on and chat. And then our Thursday format is going to be a revolving format. But one of the segments that we're really excited about that we're going to be doing on Thursdays, many Thursdays, is this drunk real estate concept where we, again, get together with a couple of good friends also in the industry who we admire, respect, have some drinks, talk some economy, real estate, investing, whatever it is. And then you get to listen in on our probably way too candid conversations.
Right. So another thing we struggled with was, what are we going to name it? We can't, if we're only doing once every couple of weeks the drinking and talking real estate, we can't name the podcast Drunk Real Estate. And so we decided between us that we were just going to name it after our company, Bar Down Investments. What the problem that goes along with that is there's checks and balances with the rest of the company people. If we're going to use our name, then we can't just be drinking and doing idiot things every time on the podcast. So we had to keep it a little bit structured. So we decided to take one of our weekly business meetings and roll it into the podcast format too.
Yeah, so on our Tuesday shows, this format, for anybody out there that's familiar with the book Traction or EOS, the Entrepreneur Operating System, a lot of companies in the industry are using it. We use it at our company. But one of the hallmarks of this Traction process is this thing called a level 10 meeting. And a level 10 meeting is basically this highly structured meeting that we use once a week to basically talk about everything that's going on in the business in a very specific format so that we can kind of address all the important topics once a week and get everybody kind of on the same page once a week.
Yeah. So full disclosure, I hate meetings. And so I had a big caveat on this that if we're going to do the level 10 meeting, I'm going to change it up a little bit, and I'm going to mix up the structure so it's a little bit less boring, a little bit more entertaining for everyone to listen to. So anyone who does a level 10, they're going to notice there's some similarities, but there's a couple different things. But it's the first thing that a level 10 always starts in with check-ins and wins, where we talk about some good things that are going, start the meeting off on the right foot. So Jay, you have any company or personal wins that you want to talk about this week?
Yeah, so I want to use this section. I actually like the idea of using this section, at least for me. You can use it for whatever you want, but for me, I want to talk about investments that I'm looking at, or investments that I've done over the past week. So, because I have a feeling our listeners, I get the question all the time, what are you investing in? What do you like? And everybody knows, or well, not everybody, but people that follow me know that I invest in a lot of real estate stuff, but I also invest a lot outside of real estate. So if we're going to talk about wins this week, I want to talk about an investment. I'm going to talk about a non-real estate investment. And this is an investment that actually you and I did together, Kyle, and I'm kind of excited about. And it's my first kind of foray into this industry. But we just invested in a company. Do you know which one I'm talking about?
Yeah, I assume you're talking about Clear.
Yeah, so a company called Clear, Klyr, and they make rum. They make heavily distilled rum. It's basically a clear rum, and they're getting distribution currently throughout the Northeast and the Southeast and parts of the Western United States. And I have a feeling that this is going to be one of the premier spirit brands in the country in the next couple years. So I'm really excited about this investment into Clear. Company started by a friend of Ashley's, your wife, and they invited us in to participate in their initial equity raise. And so for anybody out there that likes rum or wants to try a really amazing product, next time you walk into a bar, ask them for a shot of Clear on the rocks, or however you like to drink your rum.
Yeah, I've actually grown to really like it. It's they're as Jay mentioned, they're local guys. They were the major sponsor of the Phillies. As you could tell, I'm a Philly sports fan, so we're really excited to be a part of that. I think that was a great win to share with us.
The cool thing is that over the next few months, I'm going to kind of talk about how they're expanding their business, how our investment's doing. So keep tuning in, and you get to track our investments along with us as well.
Yeah, I don't know if you're setting the trend of every week talking about investment, because that means we got to invest in something new every week. But I don't
always
have
looking
the
at
capital for that. Okay, moving next along, because I know with these level 10s, you got to keep them snappy. Is our scorecard, which the scorecard is typically where we're going to talk about. Last week, our performance and how everything went, but it's our first episode, so it's going to be tough to do scorecard. But I do know that we have at least one subscriber, because my mom on the phone the other day said that she subscribed to our podcast and she was concerned that she wasn't able to download any of them, and she didn't know if she was doing it right. And I had to tell her we haven't even done a podcast, and I don't know how she subscribed, but I guess that's why we hire people for marketing and podcast editing, and because they know what they're doing. So apparently we have at least one subscriber.
Okay, well, so with the level 10, somebody needs to be nominated to keep the minutes, so I'll volunteer to do that. So our scorecard for this week, number of subscribers is 1. Got it written down.
Yeah, okay. I don't even know her screen name. So
next week
we'll give another shout out to somebody else who subscribes, but so I don't even know what her handle is. But shout out to my mom for subscribing to our podcast. Next thing that always comes in a level 10 is the rock updates. Every week when we do these rock updates, I think they're my least favorite part of the meeting. I'll put it that way. So
nobody even has any idea what rock updates
exactly are. So I'm switching this up and rock updates because I watched the movie Black Adam last week.
With The Rock.
And I thoroughly enjoyed it. And it had The Rock in it. And so I'm switching this segment up, and we're going to talk about how The Rock is doing. And so The Rock just put out that movie. I don't think it's winning any Oscars, but the production value was great. It sounded great in my surround sound speakers. It was very entertaining, and apparently he tweeted the other day that it's made $400 million. So The Rock update, he's doing pretty well for himself still.
Okay, thank you, and I guess we'll get our weekly updates on what's going on with the Rock.
Yeah, so now you don't even have to follow them. I'll keep you updated. Next, moving right along, we got headlines. So this is the meat of what we're going to talk about. So just pulling some real estate headlines from this week. We have obviously in this week headlines again was yield curve inversion. It seems to be talked about a lot with recession fears. We have an article about did mortgage rates peak. And then we have another article about the housing price index, the Case-Shiller fall for the third consecutive month. So we got to pick something from this list to move to our issues list to discuss. So which one are you feeling?
So what do we have there? We had yield curve inversion. So for those that aren't familiar, that could mean that we're potentially heading into a recession in the next 12 to 18
It's only
months.
95% predictor, though. Don't
Only
overstate it.
95%. Okay. And let's see. Did was it interest rates or mortgage rates?
Did mortgage rates peak?
Did mortgage rates peak? So have mortgage rates hit their highest point that we think they're getting in this cycle? I want to move that to the issues list because I think that's a really interesting topic, and I know there's been a lot of discussion, and everybody's asking the question: what's going on with mortgage rates? Are they going higher? Are they going to 10%? Are they going back to 1%? What's going on with mortgage rates? So let's move that one to the issues list.
Perfect. All right, so let's move right along there, and that's for issues list. Did mortgage rates peak? And so it's a good distinction when Jay actually asked the question about interest rates versus mortgage rates, because mortgage rates and like the Fed fund rate are completely different things. So when you're seeing, I think by the time this episode pops out, we might be right after the next interest rate hike, but everyone's expecting a 50 rate or 50 basis point or a half a point increase in the Fed fund rates, but that is not tied to mortgage rates. Mortgage rates are actually tied to treasuries or 10-year treasury. And the 10-year treasury is not a daily update or monthly updater. It tries to average out what rates are going to be looking like for 10 years.
Yeah, and it's important to note for anybody that thinks that, again, just because interest rates, the federal funds rate, that main interest rate that we talk about going up this week, and it's going to go up this week. Again, we don't know how much, but I like your call of 50 basis points. I think that's a half point's probably right. But just for some color on that, a month ago we saw a 75 basis point or a 3/4 point increase in that rate by the Federal Reserve. And did mortgage rates go up after that? No, they went down by almost a full point. And so it's a good example of how mortgage rates don't necessarily follow the federal funds rate. Now, in directionally speaking, when federal funds rate tends to go up, mortgage rates do tend to go up, but it's not necessarily 1-to-1. And the Fed can raise rates and mortgage rates can go down. So, Kyle, what are a couple of the things that kind of determine what's moving mortgage rates, if not the federal funds rate?
Well, and you have to. There is a distinction too when we're talking about mortgage rates. There's a distinction between adjustable and fixed as well too, and then we're talking about mortgage rates for. There's a distinction between commercial and residential. What this article is referring to is obviously residential. More people are interested in the residential mortgage rates than somebody like us. We are more interested in the commercial rates, and so when you are looking at the adjustable versus the fixed rates, the adjustable rate. So something like commercial real estate right now, the major indice is SOFR. So we'll use 1 month SOFR or term SOFR will be for our adjustable rate, and the adjustable rate will trend pretty closely with the Fed fund rates. But if you're talking about like a residential fixed rate mortgage, that ties to the 10-year treasury, and the 10-year treasury, it's going to look at, okay, what does it think that interest rates are going to be doing over the next 10 years? So even though the Fed is saying, hey, we're coming out with another half point rate hike, the market's going to look at that, and the 10-year treasury is going to look at that, and it's going to say, hey, that's them slowing down. The last couple rates were 75 basis. This is a 50 basis. So we can start to see the light at the end of the tunnel. We no longer think, I think Bloomberg at one point said, is the Fed fund rate going to go up to 7% or 8%? We no longer think that is a likely scenario where it's going to go to 7 or 8%. We think we know this is going to level off and then most likely come back down. So therefore, even though it's going up 50 basis points, we think we know the end game. So therefore, we think we know where the 10-year rates are going to end up.
Yeah, and so I like to say that a lot of what drives mortgage rates is this whole idea of volatility. And it's exactly what you just said, which is when we don't know what's going on in the economy, when we don't know what the Fed is likely to do over the next several meetings, everybody gets scared, and there's a lot of volatility in the market, and that kind of drives rates up because people don't know if there are going to be things that the Fed does that are going to naturally drive rates up. And then when things calm down and there's less volatility in the market, when people are more certain of where we're headed, and it doesn't necessarily mean certainty that we're headed to good times. It could be certainty that we're headed towards bad times. But just certainty in general, when we have some certainty, there's less volatility and rates tend to settle down. And one of the things that we've seen over, well, at least the last month is that inflation is starting to come down a little bit. And we can argue about whether inflation's really coming down or not. I think it's coming down more slowly than what a lot of people think, but I do think it's headed down. But here's the big thing. The way that we typically, or at least the media, let's call it Wall Street and Main Street, the way that Main Street typically looks at inflation data is they look at what's called the trailing 12 on inflation, which means they look at the last 12 months of inflation changes, and they average those out to give you your inflation number. And so every month we get a new number, and that number will replace the same month the previous year in that 12-month average. And so what we saw last October, November, December was really, really high monthly numbers. So this year, when we get our October, November, December numbers, they're likely to be lower than last year. So we're going to have a lower number this year replacing a high number from last year, which is going to bring that average down. And so we already saw that in October. We saw I think it was 0.3% increase, which is about a 4% inflation number, which is still moderately high, but it replaced a really high number from last year. So it brought that 12-month average down. And so this month, we're expected to see the November number, which is almost certainly going to be less than last November. December is going to be almost certainly less than last December. January is going to be almost certainly less than this past January. So most likely for at least the next 3, 4, maybe 5 months, what we're going to see is this average inflation number coming down, even if the monthly number is still relatively high. And so I think Main Street's going to report this as good news. Everybody's going to be excited that inflation's coming down, and I think that's going to help the market settle even more. I think we're going to see a bump in the stock market. I think we're going to see a drop in mortgage rates again, and I think everybody's going to kind of be happy for the next couple months until one of two things happens. Number one, that inflation number stops dropping. And that could happen in the spring when we start replacing lower numbers with lower numbers, or when unemployment numbers start to spike up. Now, as the Federal Reserve raises interest rates, the historically natural occurrence is that businesses have a tougher time staying in business, people spend less money, and businesses have to start laying off. And so the thought is at some point, unemployment's going to start to spike. And when unemployment starts to spike, kind of things start to go off the rails, and that's when things fall apart. So my take is that for the next 3, 4 months, we're going to see some low volatility. We're going to see the market kind of stay strong, but who knows what could happen leading into next summer. I think we could see a second wave of inflation. I think we could see unemployment spike, and I think we could be hitting a recession by the summer.
I'm glad you brought up volatility because it's a double factor when it comes to mortgage rates, because the volatility it will affect, and based on everything that you just talked about, will affect what the actual Fed funds rates are and the expectations for the Fed funds rates. But volatility is also a killer for banks. Banks hate volatility. It's like their least favorite thing. They want to have, their rates aren't high, so they want them to be stable. And when you factor in volatility, that that just takes away from their stability and their whole business model. So when there's volatility, not only are you going to have the 10-year treasury going up, you're also going to have banks putting an extra little bit of spread on top of that. So you'll see, or the VIG, as you might say, so a bank might put 200 basis points above the going index as their take on something, but in volatile times they might bump that up to 3. They might go 3.5. So as that volatility comes down, it also brings down that extra spread on top of the indices. So that's going to bring it down. So basically the conversation we're having is, do we think that the 10-year treasury has peaked, and do we think that volatility has peaked? If you're asking me, I'd like to believe so, pending some other crazy thing happening. But you have to understand, crazy things happening. People keep talking about the Fed's going to hike rates until something breaks. If something breaks, there's a high likelihood with the modern monetary policy that if something breaks, they're going to drop rates and they're going to start QE, and that's going to lend to lower mortgage rates. So pending something crazy unforeseen, I think we have hit a peak in mortgage rates.
Yeah, and I don't want to speak for you, but just to clarify, when I say we've hit a peak, I don't necessarily mean today's rate. I think we're like 6 and a little bit. We were at 7 and a little bit. I think we may see an increase in rates a little bit, but I think that max that we saw, that we kind of came off of last month, at somewhere around 7% or 7.25%, I think that is by far the peak. So I'm not saying that today's rate of 6%, which is the average 30-year mortgage rate today, is necessarily a high point. But I think the high point that we've already gotten to, we're not going to surpass that again in this cycle. That's my guess. And I really, you brought up a really good point about banks adding that kind of that extra spread on top of their loan rates. It's worth noting that they do that in the mortgage world, but they also, even more so, do that in the personal loan world. So if you're going to get, whether it's credit cards or business bank loans or personal bank loans or car loans, typically during times of volatility, that spread is much higher. And so that's another thing that if we see more volatility in the future, we could see higher rates for more personal commercial products. And that could obviously hurt the economy as well. And so, but yeah, I think we both agree that we've kind of hit a peak on mortgage rates for now. So I think that's a good thing. And not saying that it's all smooth sailing from here, but I think we're at least one thing.
But mortgage wise, we don't see them raising anymore. So you can sleep soundly if you're planning on getting a mortgage, that you're not going to pay any higher if you're listening to us. So I think we solved that issue.
Look at that.
Issues done. So let's start to wrap this up a little bit then. So to-dos list. You have anything dropping or pertinent that has to be done this week?
Yeah, well, I do want to mention that, like I said, we're normally going to do this format on Tuesdays, where you and I kind of tackle the important issues of the day, and then on Thursdays we're going to do shows with a different format. We talked about that drunk real estate format, where it's going to be you and me and two really good friends, kind of sitting around, chatting, drinking, talking candidly. And then we may do some other formats as well. Who knows? Maybe some Q&A or some interviews. But instead of releasing this week on Tuesday, we decided to drop this very first episode on Thursday. But coinciding with this drop is we dropped our first drunk real estate episode today. So as soon as you're done listening to this one, as my kids would say, smash that subscribe button. But then jump on over to episode number 2 of the show, which is our first drunk real estate episode, where we have a couple amazing guests, and I'm not gonna ruin it by saying who they are. But I think you're going to enjoy that episode as well.
Well, let's be honest though, Jay. When you see 2 episodes drop and one of them's called Drunk Real Estate, I assume everyone's coming from the Drunk Real Estate episode and coming over here as their second listen. I know I would. But let's wrap this up. So at the end of every or the end of every level 10 meeting, we have to give a rating. So how do you rate this on a 1 to 10 scale?
Yeah, so for those that don't know, the term level 10 actually comes from this concept of you rate the meeting on a scale of 1 to 10, and the goal is to get as close to 10 as possible. And if you rate it less than 8, you got to explain why. So I'm gonna do an 8, so I don't have to explain why I chose a number anything lower than 8.
That was my philosophy. Once Ashley implemented the level 10 meeting, and she said if you do below an 8, you have to explain why. And even on those weeks that people are like, oh, that was a really bad meeting, let's do a 5. I was like, no, that was a solid 8, I think, guys. And so I never had to explain myself. So I'll give an 8.5. Just to give us a little bit of momentum going into next week. So we feel like we should do this again.
Okay. I'm writing that down. 8.25 is the average for today.
There
we have
go.
some room for improvement, but we did a pretty good job.
Okay, great. And we can add that to scorecards so later. So how do you want to sign this off? How do we want to end off our first episode?
I'm going to put you on the spot, and I'm going to make you give us a quote. What's your favorite quote?
Quotable. So are you going to put me on the spot every week with a new quote? So I should come prepared next time.
I may not be a quote. I'm not gonna give it away. I'm gonna put you on the spot every week. Maybe it'll be a quote. Maybe it'll be something else. But this week I'm going with a quote. Give me a quote.
All right. Just a little insight into my life is my grandfather was my only influence for real estate. I noticed that my parents are both school teachers, so they were perpetual W-2s. And they gave me a great basis for schooling and for who I am today. But my grandfather had made an effect on me when I noticed he was the only rich one in our family, and he was the one who had bought all this real estate and made all this money on real estate. And so I wish he was still around with me today to give me some better quotes. But the quote that I remember from him was, I had to have been maybe 12, 13 years old, just around that age where you start dating. And
dating?
Yes.
I thought we were about to get money advice.
Oh no,
Okay,
don't just wait. And so the quote that I remember him, he pulled me aside one time. We were sitting next to each other watching. I think he was a Cleveland Indians fan, and he said, "Well, just keep this in mind. It's just as easy to love a rich girl as it is a poor girl." And they just kept watching the game. So that's his quote that stuck with me. So I don't know if that's the quote you were looking for, but it's one of my favorite quotes that
do we put that in the category of financial advice or romantic advice?
I think it's both.
Okay, I'm gonna pass that on to my kids today.
I'll write that down. All right. Well, we appreciate everyone coming, taking this journey with us, making it through the first episode. We hope if you got some knowledge out of it, that you'll tune in again, and you'll also tune into our other segments, specifically this week, Drunk Real Estate. But thanks for coming out.
Thanks, everybody.